So we're going to work on Critter Incorporated's transactions during the first month of the business. We're going to try to create their three main financial statements: their income statement, revenues less expenses; their cash flow statement, sorted by operating, investing, and financing; and then their balance sheet, all their assets, their liabilities, and their equity. So let's start. We have to start one transaction at a time, and we've got the accounting equation here. We have a number of different assets here, equal liabilities plus our equity. And retained earnings goes up by revenue and down by expenses and down by dividends if there are any, but there aren't any here, so you don't have a dividend column. Alright, so let's see. The first month, July 2nd, the owners contributed $8,000 in exchange for shares of stock. So we're going to have $18,000. $18,000 of cash going up, and then we're going to record that we got $18,000 in exchange for the shares. So now our accounting equation is in balance. Cash went up, equity went up because of the stock that was issued. Alright, July 3rd, we're going to pay $1,000 for rent for the month of July. So we're paying for July, so that would be July's rent expense, and cash is going to go down. So cash is going down. We're going to record rent expense of $1,000, and that's going to make retained earnings go down. Okay, so I'm going to reflect it both in the balance sheet, the impact that it has on retained earnings, and I'm also going to show my two income statement accounts so that when the time comes, I'll be better able to populate my three financial statements. Okay, so July 5th, I purchased equipment and tools for $18,000, a down payment of $5,000. Okay, so cash of $5,000, and the rest due in 30 days. So we're going to have some of that being debt. Okay, so let's put some debt in there. Actually, let's just call it accounts payable since it's only due in 30 days. It's not going to have any interest associated. It's probably more accurately portrayed as accounts payable, and let's put it in here as we now own equipment and tools. So some of this was just a rearrangement within the assets, and some of it was in the liabilities. In my account equation, this nets out to 13 on the asset side and 13 on the equity and liability side, so my balance sheet, my account equation is still in balance. Maybe I'd like those equal signs to be down, so each line has to balance. Okay, July 17th, we're going to create some marketing materials that's going to be paid with cash. Alright, so cash is going to go down. And I'm going to have marketing materials expense or selling expense probably of some kind. So I have an expense of $200, and that's going to reduce retained earnings. So now my balance sheet is in balance. All of these columns equal all of these columns. And these two columns just net into this one. Okay. And so let's see here. July 28th, we're going to pay $1,000 for August rent. Well, we're in July, so if we're paying for next month's rent, then that's a prepaid. And we're also going to be paying for this month's utilities. So the whole check is going to be for both the rent and the $450, but the rent is for next month, so it's not used up yet. That should have been a minus. And the $450 for this month's utilities. So we've got utility expense, and that will reduce retained earnings. Alrighty. Let's see, July 30th received $8,000. Oh, we're finally selling to customers. Hallelujah. That's the transaction you really rate for, not the transaction where you're rearranging assets or where you're spending money, but where the customers are buying something for you. Alright, so we received $8,000 for services. So we got revenue. We did something with the customer. When we did the thing for the customer, we've got revenue. So let's go over here. Finally, something in the revenue column. And did we get the cash for that, or are we going to we got the cash for some of it, $8,000, and some of it we billed and we haven't gotten yet. So revenue is going to be both the cash that we got plus the stuff that we billed. Okay, so the revenue is going to be both. Great. You could have also put that on 2 lines if that's easier for you to understand and track what was going on. So we had 2 transactions, one for cash and one for credit. Okay, paid sales commission for July. Okay, I got questions when the sales commission is more than half of the revenue, but I didn't create the business model. Alright, so we've got sales commission there. That's an expense. I should have put this in here. Okay, what else do we got here? Okay, so that's the last of the transactions. Now, in order to get the income statement, I've got to go collect all of my revenue, and my expenses are all of these things here, and so my profit is the net of those two. So there's my profit for the period. My operating cash flow, what did I collect from customers? The only thing I got was $8,000. What did I pay to vendors and employees? Let's see here, I paid for rent, and I paid for marketing or selling expenses, and I paid for some next month's rent and the utilities, and I paid for sales commission. Alright, the net of those two. So my operating cash flow is actually negative. I paid out more than I collected. I purchased some tools and I used some cash for that, and I got some cash from owners. Let's see if this nets out to the cash that I have at the ending. Okay, so let's get my ending balance in these various balance sheet accounts. Just do a sum there, sum them all up. And so the ending cash here does match my ending cash here. I started out with 0. So the net change in cash is correct, and you can always check yourself that way. Alright, let's build the balance sheet now. I don't know how to make that sucker go away. Alright, here we go. So cash is there, and accounts receivable is there. Prepaids are there. Tools are there. So let's add up total assets. There we go. Alright, accounts payable, we still owe for the rest of those tools. And so total liabilities is just AP, that's the only one we had. So then the stock and retained earnings and total equity would be those added together, and liabilities plus equity. And does our balance sheet balance? It does. And there you go.